Welcome back, dear students and scholars. In video 1, we built the foundation for prepaid expenses, pre production costs, and deposit accounting. Now we move into the main contract cost area of ASC 340. ASC 340 Contracts with Customers. This lesson connects deferred costs with ASC 606 Contract Economics. We will study cost to obtain a contract, cost to fulfill a contract, amortization, and impairment. The big question is practical. When does a contract related cost become an asset, and how does that asset later move into the income statement? The contract cost problem starts with a warning. Not every selling cost becomes an asset. When an entity incurs a cost connected with a customer contract, the first question is not how much did we pay? The first question is, does this cost qualify for recognition as an asset at all? Four outcomes are possible. The entity may recognize an asset, expense the cost immediately, amortize a capitalized cost over the benefit period, or test the asset for impairment if recoverability declines. So the treatment depends on cost type, contract linkage, recoverability, and the correct codification topic. Accounting likes structure. It becomes nervous when we throw all costs into one bucket. Before applying ASC 340, we must pass the scope gate. This topic is not the first answer for every contract related cost. If the cost is inventory, ASC 330 may control. If it is pre-production tooling or design under a long-term supply arrangement, ASC 34010 may control. If it is internal use software, ASC 35040 may control. If it is a tangible long-lived asset, ASC 360 may control. If it is software developed for external sale or licensing, ASC 98520 may control. The rule is simple. If a more specific standard governs the cost, do not force ASC 34040 onto it. ASC 34040 separates contract costs into two families. The first family is costs to obtain a contract. These are costs incurred to win the customer contract, such as a qualifying sales commission paid only when the contract is signed. They must be incremental, recovery must be expected, and a practical expedient may be available if the amortization period is 1 year or less. The second family is costs to fulfill a contract. These are costs incurred to satisfy future performance obligations under a specific contract or specifically anticipated contract. They must relate to the contract, create or enhance future resources, and be expected to be recovered. Different family, different test. Let us begin with cost to obtain a contract. The recognition model follows a direct path. First, the contract must be obtained. Second, the cost must be linked to obtaining that contract. Third, the entity must expect to recover the cost either directly through reimbursement or indirectly through contract margin. If these conditions are satisfied, the entity recognizes a contract cost asset. But the story does not end at recognition. The asset is later amortized on a basis consistent with the transfer of the related goods or services. That is how ASC 34040 connects the balance sheet asset with the ASC 606 revenue pattern. The key phrase here is incremental cost. A cost is incremental if it would not have been incurred if the contract had not been obtained. A qualifying sales commission is the classic example. No signed contract, no commission. A fixed sales salary usually fails because it is paid whether the contract is won or lost. A general sales bonus may fail if it is based on broad performance and not tied to a specific contract. Bid team payroll often fails because a cost is incurred during the pursuit process whether or not the bid succeeds. The test is not whether the cost helped the sale, the test is whether the cost exists only because the contract was obtained. Recoverability is the next filter. The entity must expect to recover the incremental cost. Recovery can come directly from the customer or indirectly through the margin in the contract price. It does not need a separate reimbursement clause, but management must have support based on facts and circumstances. ASC 34040 also provides a practical expedient. If the amortization period for a qualifying cost to obtain a contract would be 1 year or less, the entity may expense it as incurred. But be careful. Expected renewals, amendments, or follow on contracts can extend the benefit period, so a cost that looks short term at first may still require tracking. Now, let us look at common traps: bid and proposal costs, travel to negotiate, due diligence costs, advertising, marketing, fixed sales salaries, and broad success bonuses are usually expensed as incurred because they are not incremental to a specific obtained contract. They generally would be incurred whether the customer signs or walks away. There can be an exception if a cost is directly related to a specific contract and explicitly chargeable to the customer under the contract terms. But that exception needs careful documentation. Otherwise, a contract cost asset can become an accounting costume party. It looks dressed up, but underneath it is still an expense. The CloudMetric case makes the treatment clear. On January 1st, 2027, CloudMetric signs a 3 year analytics services contract and pays a recoverable sales commission of $18,000. The commission is payable only because the contract was obtained. So CloudMetric records debit contract cost asset $18,000 and credit cash or payable $18,000. The contract term is 36 months, so monthly amortization is $18,000 divided by 36 months, which equals $500 per month. Each month, the entry is debit amortization expense $500 and credit contract cost asset $500. Fixed salary and bid travel are expensed as incurred because they fail the incremental test. Now we move to cost to fulfill a contract. These costs arise after a contract is obtained or when the entity is preparing to satisfy future performance obligations. The first gate is always whether another standard applies. If another topic governs the cost, ASC 34040 stops there. If not, the cost must relate to a specific contract or specifically anticipated contract. It must create or enhance resources used in future performance, and recovery must be expected. If all gates are cleared, the cost is capitalized. If any gate blocks the cost, it is expensed as incurred. This gatekeeping prevents double counting and prevents ordinary operating costs from becoming assets. ASC 34040 gives three affirmative capitalization criteria for fulfillment costs. First, the cost must directly relate to a specific existing contract or specifically anticipated contract. Second, the cost must generate or enhance resources that will be used to satisfy performance obligations in the future. Third, the entity must expect to recover the cost. These criteria are conjunctive, which means all three must be met together. If one fails, the asset treatment fails. A cost cannot say 2 out of 3 should be good enough. Under this rule, accounting is strict. It wants the full set before it allows balance sheet recognition. The capitalize or expense table is a very useful control tool. Direct labor dedicated to contract performance, direct materials consumed in delivering the performance obligation, contract supervision, direct overhead allocations, and cost explicitly chargeable to the customer may be capitalized if the criteria are met. On the other side, general and administrative costs not explicitly chargeable to the customer are expensed. Wasted materials, unpriced rework, costs related to past performance, and costs that do not enhance future performance capacity are also expensed. If a cost has both capitalizable and expensable components, management must allocate the amount reasonably and document the method. Setup and implementation costs can require serious judgment. Some setup activities create resources that help the entity satisfy future performance obligations, and those may qualify if no other standard applies. Learning curve costs must be assessed carefully because some early inefficiency may support future performance, but not every learning cost is an asset. Hardware and equipment usually belong under ASC 360 as property and equipment, not under ASC 340. Abnormal waste and unproductive labor are expensed as incurred because they do not create or enhance future resources. In simple terms, normal setup may qualify, but waste does not get a promotion to asset status. Let us apply this through SecureGrid. In 2028, SecureGrid begins a 4-year infrastructure monitoring contract. It incurs $42,000 of qualifying setup labor and $18,000 of direct integration materials. Together, these total $60,000. So the entry is debit contract fulfillment asset $60,000 and credit cash or payables $60,000. It also incurs $12,000 of general administration overhead and $4,000 of abnormal rework. These total $16,000. So SecureGrid records debit expense $16,000 and credit cash or payables $16,000. Hardware deployed at the customer site is evaluated separately under ASC 360, not forced into ASC 340. Once a contract cost asset is recognized, it must be amortized systematically. The amortization method should match the pattern in which the related goods or services are transferred to the customer. If services are delivered evenly, straight line amortization may be appropriate. If a cost benefits more than one contract, the amortization period may extend beyond the first contract. If expected renewals will benefit from the same cost, the amortization period may include those renewal periods. The main idea is that expense recognition should follow the economic benefit. The asset starts on the balance sheet, but it does not live there forever. Contract extensions can change the amortization estimate. Suppose a $60,000 fulfillment asset was originally amortized over 4 years. Annual amortization is $15,000. After 2 years, $30,000 has been amortized, leaving a carrying amount of $30,000. If the contract is then extended for 2 additional years, there are now 4 remaining years of benefit. The 2 original remaining years plus the 2 extension years. The remaining $30,000 is amortized prospectively over 4 years, giving new annual amortization of $7,500. This is a change in accounting estimate under ASC 250, so we do not rewrite the original recognition entry. Contract cost assets also require impairment testing when recoverability is in question. The correct sequence matters. First, consider related assets governed by other applicable topics, such as inventory or other specific assets, as required by those topics. Then test the ASC 340 contract cost asset by comparing its carrying amount with the remaining expected consideration, less direct remaining costs not yet expensed. After any ASC 340 impairment is recognized, subsequent asset group or reporting unit testing may be performed where required under other guidance. In the example, the carrying amount is $70,000 and the recoverable amount is $50,000. So the impairment loss is $20,000. The entry would be debit impairment loss $20,000 and credit contract cost asset $20,000. Let us close with the reporting control board. For every contract cost, first identify the contract and cost family, obtain or fulfill. Second, check other ASC topics before applying ASC 340. Third, document recoverability with margin support, pricing analysis, and renewal assumptions. Fourth, track the amortization period and any renewal or extension assumptions. Fifth, review impairment at each reporting date and follow the correct sequence. In the next video, we will move into practice questions, mini cases, an IFRS 15 bridge, and an SAP system bridge for contract cost tracking. Thank you for studying with me. If this lesson made ASC 34040 clearer, please like the video, subscribe to the channel, support the course, and share it with a colleague who wants practical US GAAP learning.